Before you place another trade, before you risk more money, before you blame the market again, stop. Most traders are not losing because they have bad luck. They are losing because they are trading without understanding the one thing that controls everything: market structure. They focus on entries, indicators, signals, and strategies, but they skip the foundation. And when your foundation is broken, everything collapses. Welcome to Trading Them First, where you get genuine and real trading education. My name is Osarobi Emmanuel. On this channel, my mission is simple: to help you understand the market clearly so you can stop guessing, stop forcing trades, and start improving. One of the most important skills you need as a forex trader is the ability to read market structure. It is a critical skill that will allow any trader to use the right price action strategy in the right market condition. It's very important. You have to go back to the last video so that this video make a better sense to you. What is market structure? It is simply the study of the market behavior. If you can master this skill, then you will be able to answer this question: who is in control of the markets? Is it buyers? Is it sellers? What is the right time and place to enter? The right place to exit, and when you need to stay out of the market. Remember, there are three types of market structure. We have the bullish market structure that forms higher highs and higher lows, higher highs, higher low, higher highs and higher lows, and continues that way in an upward direction. This is a bullish market structure. And we have the bearish market structure that forms lower low, and we have the sideways market structure, the sideways market structure that forms equal highs and equal lows, equal highs and equal lows. And don't forget, I told you these higher highs and higher lows you're seeing are called resistance, 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 resistance. And this higher low and lower low, higher low and lower low, all these points you are seeing are called support. The higher highs and higher lows are also called swing points or turning points or reversal points, where the market makes an impulsive move. This is an impulsive move and pulls back or retrace, then makes another impulsive move, pulls back or retrace, makes another impulsive move. These points are called the swing points. The swing points, the swing points, they are areas where the market makes a U-turn before continuing in the original direction. Remember, in our previous video, we talked a little about break of structure. BOS, break of structure. A break of structure is simply the process of forming a higher highs and a higher low in an uptrend, and a lower high and a lower low in a downtrend. Right now, I'm going to show you a mechanical approach that I use to identify and mark break of structure. This approach removes guesswork, indicators, and emotional decision making. Rules of a valid break of structure. The candle body must close beyond the previous high or the previous low in a downtrend. If the wick of the candle breaks through the previous high or through the previous low, it is often a liquidity sweep. Stop hunt. It is called a stop loss hunt and not a valid break of structure. We'll see that when we go to our chart. In an uptrend, wait for the current candle to close below the low of the previous candle. And in a downtrend, wait for the current candle to close above the high of the previous candle to establish your swing range. We are going to use AUD USD on the weekly time frame for this example, after which we are going to apply the same concept to the lower time frame. There's an actual step-by-step process we need to apply here to determine our current range in the market. So let's start with the bullish market. As you can see, the market moved down, pushed down, and formed a low here, then moved up to form this high. Then it breaks structure here. This is where it break the structure. It came down, formed this low, then rallied up and break structure over here. Over here, this is where we have the bullish break of structure. Over here we have the bullish break of structure. The first rule states that the candlestick body, that is, as you are seeing, this bullish candlestick body must close beyond the previous high in a bullish market. The market came down here, formed this high, then rallied up and broke structure here. So the candlestick body must close beyond the previous high. This is the previous high. As you can see, this candle
closed beyond this high over here. This bullish candle closed beyond this high over here. So this is a valid break of structure. Let me put it there, BOS, which stands for break of structure. I hope you can all see this clearly. It was to be a weak break. I mean, it was like this. This is a weak break, and a weak break for this very model is not a valid break of structure. It must be a full candle body close. This candle must close above this high, not weak. In this case, it is a wick. As you can see, the wick of this very candle closed above the previous high, so it is not a valid break of structure if we were to use this very candle. But over here, the market broke the structure, this very high over here, with its full body. So we now have a valid break of structure. So from this point where we had the break of structure, you look down to find where you can see the next candle closing with its full body, not weak, beyond the low of its previous candle, where the next candle is closing beyond the low of its previous candle. And if you can see, this one does not close beyond the low of this one does not close beyond the low of this one. You can see this very candle is closing below the low, or is closing beyond the low of this very candle. So we take the lowest point in this move. As you can see, the lowest point in this move is over here. This is the lowest point in this very move. So we take our trend line 2, then we draw a line. So this becomes our valid low, or our swing low. Either I call it swing low, let me just call it swing low. We now have our swing low, so we need our swing high, so that we can establish what is called a trading range. Still, from this very candle that broke structure to the upside, the same rule applies. We are looking for close down, where the next candle closed below the low of the previous candle with its body. As you can see, this one did not close below the low of this very bullish candle. You can see that this very candle closed below the low of this very bullish candle. This very candle. As you can see, it closed below the low. Then we take the highest point in that move, which is here. So this becomes our swing high. This becomes our swing high, or our valid high. So from this swing high to this swing low becomes our trading range. Either I call it trading range, or you call it a valid range. Let me change the color so that you can see it clearly. So let's go to the bearish market. The same concept applies for the bearish market. Price rallied up and begins to crash. As you can see, it broke structure over here. This is where we have the bearish break of structure. In the bullish market structure, we were looking for where price closed down below the previous low. But in a bearish market structure, we are looking for where the next candle from that point where the market broke the structure, either to the downside or to the upside. We are looking for where the next candle closed above the high of the previous candle. Coming down, this very bullish candle didn't close above this one, above the high of this one. It could not close with its body above the high of this one. Let's go to the next candle. This very candle, its body close above the high of this very one. So we take the lowest point in this move, we mark the lowest point in this move. This becomes our swing low in a bearish market. Now we have gotten our swing low. The next thing we need now is our swing high. So to get our swing high, still from that point where we had the break of structure to the downside, where we had the bearish break of structure to the downside, from that very candle, as you can see, is this very candle, we trace it back upward. This very candle is not closing above the high. The body is not closing above the high of this one. The body of this very candle, as you can see, the body of this very candle is not closing above the high of this very one, of this very candle. It's not closing above the high. Then we check the next candle. This candle is closing above the high with its body. It's closing above the high of this very one over here. So we take the highest point in this move as our swing high. We mark the highest point in this move as our swing high. So this becomes our trading range. From here, this swing low, from this swing low, this weak low to this strong high becomes our trading range. I am on the AUD USD weekly chart. As you can see, the price is collapsing. That is, we are in a downtrend. That this is a bearish market structure. Just looking at it, if you can see, we have a breakout structure over here, and in this very move, this is the lowest point in this very move. So the rule says we are looking for a candle to close above. We have the next close above here. This is where we have the next close above here. So we take the highest point. This becomes our swing high. This is the highest point here. So we look back from this move where we have the breakout structure. We are looking for the next close above. We didn't have it until here, so we take the lowest point, which is here. So we draw a line again. This becomes our weekly swing low. Weekly swing low. So as you can see, we have another breakout structure here again. Let's just zoom and see. We have another break of structure. Even if it's a break by a peep, it is still a valid break of structure. As you can see, price pulled back, came back and tested this level and broke the structure again to the downside. So we are looking for the next close up, which we don't have until here. So this will become our new swing high. This becomes our new swing high. Yes, we will have another break of structure again. So as you can see, this very structure is still very much bearish. So from this very point, we look for the next close up. The next close up didn't happen until here, so we'll take the highest point. So we'll have to shift this over here. This is our next weekly swing high. This is our next weekly swing high. Let me just add high here. This is our next weekly swing high. So from this very point, we look for the next close up, which is here. So we'll have our swing low. The next swing low will be here, and price broke structure over here again to the downside. So we'll have to adjust the swing low to this very point. Then we'll look for the next close up from here. From here, we'll have the next close up is here. So our next swing high will be here. We now have our swing high, so we're looking for our swing low. So from where we had the break of structure BOS, we are looking for the next candle that close above its previous candle, which we don't have until here. So this becomes our weekly swing low in the market. Always remember, structure is the language of the market. Every high, every low, every break, every rejection is information. If this information change your perspective, comment I understand. In case you didn't understand, more videos are coming. Just stay tuned, subscribe. My name is Enfos. See you in the next video.